You know what you're doing is rule-based. This is what time the market should be doing this. This is where the market should be gravitating towards, and this is the draw on liquidity. I'm submitting to that idea when I'm looking at the charts, and I'm waiting for something to be a catalyst that I've been studying for months and did back testing on. I see it, it makes perfect sense to me, and I know where to place my stop. I know when I would move my stop. I know when I'm going to take my first and second, third, if it's possible, partial. I'm also looking for the things that would negate the idea. What kills the trade idea? These are all things that you have to have understood. Just because you have been consistent here and there with demo, don't think that you are prepared to trade with a funded account or live funds. You're not. I'm trading with this approach, more accurate, less drawdown, less heat on your trades when you put them on, more confident to hold for not your first normal first scale out profit. Your first profit now would be your typical second partial. That's how you graduate into that point of holding for a full pull. You just can't quit cold turkey and say, okay, I'm not going to do any partials anymore. I'm just going to go straight in and get all my targets. And then what happens is, invariably, you're going to have trades where this is for you, when it didn't let us get our full target, but we had 19 handles. We didn't get to 20. Right now you have 10. And you're going to be thinking, like a deer in headlights, what do I do? What do I do? Because if I'm wrong by not getting out right now, I'm going to regret that. It's going to be more remorse. But if I hold and it moves to my profit objective, then I'm right. I'm right. Damn it, I'm right. I did what I was supposed to do. It went to my target. I'm done. I did it. I slayed it. But even if it gets to that target, you're going to be remembering how painful it was to hold on to that. If you start feeling uncomfortable and it feels like you're juggling. Do I close it? Do I hold it? Do I move my stop? Do I move my stop back? Did I move it too soon? As soon as your mind enters that, at that very moment, you have lost the plot. You must take half the trade-off, because you will punish yourself mentally if you do anything that leads to either stopped out or not getting to target. Because at that moment, here's what you don't realize, and this is what you need to be writing down in your journal. As soon as you get to that point where you're in troubled waters and you're now taking more attention to, what do I do? What do I do? If you're asking yourself, what do I do? And it's becoming physical, like your breathing increases, the rate of your inhalations. Maybe you're getting heart palpitations, feeling dizzy, feeling anxious, feeling nervous. The answer to that is take half off. And what that does, it allows your mind to reset. You've paid yourself. Who cares if it comes back and stops you out? The way we regain that clarity, take half of the position off. The market's going to run for some hourly old high or an old low. This is the part where you start writing down notes, folks. Every day there's an intraday range that has an old 60-minute high or old 60-minute low. In between where the market is at market price, whenever you're sitting down and looking at your charts, you want to identify them because there's liquidity there. This is the surest way for you to know that you can go in there every single day. Every single day, this is forming. There is not a day that this does not form, okay? This is an everyday bread and butter logic. You mark out your 60-minute highs and lows. You wait for some shift in market structure that would be gravitating towards that old high or old low. Once you have a shift in market structure, using just what I taught in the 2022 model, you wait for a fair value gap. As soon as it trades into it, you engage. Half of the range from wherever you're getting in to that old high or old low, whether you're aiming for a bull move or bear move, matters not. As soon as it moves half of that range, half your trade comes off, stop the break even, and you submit to whatever happens then. That's it. That's all you have to do. That is a complete model. Don't risk more than 1%. It might be 5 handles, it might be 20 handles, it might be 30 handles. How are you going to know? The range between where you're trying to buy and where that old high or old low is. That fair value gap exists every day. Liquidity above old highs and old lows, below old lows rather, that's there every. So the trader in you should not be talking about, I want to buy here, I want to sell here, I would do that, because that's not the trader talking. That's retail Rick. That's the gambler in you. So you've got 3 people inside of you right now that's going to be wrestling to be in the driver's seat, ignoring the analyst, which is the sound advice that you should be following. So how do you deal with that? Your plan needs to be written out. When I take a trade, I have a notepad next to me. I'm literally writing down target, partial, stop won't move until it gets to this price. That's it. So if I see something, some little flurry of price action comes in, boom, if it doesn't break the rules that I have written down for my idea, I'm not moving my stop. I'm not panicking. But it might cause a concern for me to feel like the analyst is saying, okay, we now are in troubled waters. What's the process? Half off. Don't move the stop anymore. Or if it's not moved to better the break even, move the better to break even, and then let it go. Submit to whatever happens. Listen, when you're looking at the charts, you need to be able to see in your mind's eye, can you physically see the price running up to that relative equal high? If you can see it, that's the first step. You have to be able to see that that potentially is in the chart. It could manifest itself. Now, how it finally gravitates to there, is it going one straight shot, or is there two price legs into it, maybe three price legs before it gets there? That's not important. You're submitting to the idea that you are seeing this present price action. It's likely to go up to those relative equal highs where there's buy side liquidity. So you're submitting yourself to what? I'm in a buy program. I'm going to be buying discount arrays. I'm going to be observing price and looking to see if down close candles support price and repel it higher. To the left of all that, if there is a range in price action, I want to see up close candles being traded through. That's institutional order flow that we're not pursuing being right, okay? It really is impactful when you go into your trading day, giving yourself permission to not be perfect. If you're wrong, it doesn't mean that it's a failure. It just means you're wrong. And you can be wrong and make money. That's what a sound model does. How can you be wrong? How can you be wrong and make money? Partials. There has never been a partial that was taken in a trade that did not yield a gain or profit. It cannot happen. A partial profit is profitable, and you take that when it offers it to you. Then, if the trade doesn't go to your targets or target final terminus and stops you out on the balance, guess what that means? You were wrong. People ask, why don't you explain to us what makes you see a trade or when a trade isn't good for you? How do you differentiate something that's in the charts? Like, how do you know when a trade's really there? What are you looking for? Well, again, it gets back to experience. You can't, well, think about what you know now. Do that for a second. Think about what you understand about fair value gaps in 2022 model, how price goes to old lows for liquidity, above old highs for liquidity. It's incremental. Folks, listen, every single day, the market gravitates to buy side liquidity or sell side liquidity. And before it gets there, there is a fair value gap. That's always there. It's always there, folks. It's never going to be hidden from you. So what do you do to satisfy when you're right more times than you're not? How do you stay satisfied? You pursue excellence, excellence in execution, excellence in precision, excellence in managing risk. You refine your craft. Sell short the ES. You sell short at 4,000, hypothetically, and it drops down. It pulls back into a fair value gap that's still bearish at 39.96. Okay, you can sell short one more there. It breaks down, goes into 87, comes back up to 90 into a fair value gap or a bearish breaker. You can add one more there. You're still trading one contract, but every one of these new pyramid entries is a trade in and of itself, and you gradually build up that way. But you're still a one contract trader. You're just adding more incrementally, one contract at a time. That's called pillaring.